You know what? I just watched something happen in the silver market that honestly shook me to my core. And if you're invested in precious metals, or even if you're just watching from the sidelines, what I'm about to share with you needs your full attention, because this isn't just another market move. This is history being written right in front of our eyes. Silver just crashed 22% in 2 hours. Let me say that again so it really sinks in. 22% in 2 hours. We're talking about a drop from $90 all the way down to $73 overnight on the Shanghai Futures Exchange. And right now, as I'm recording this, Western spot prices are hovering around $75. Western futures are at $76. But here's where it gets absolutely wild. Shanghai spot is sitting at $86. Shanghai futures at $90. That's a $10 premium that's still holding strong in China, even after this absolute massacre we just witnessed. Now, before we go any further, I need you to do something for me right now. Hit that subscribe button and turn on your notifications, because what I'm about to break down for you is information that could literally change how you view this entire market. And honestly, with the way these platforms work, with the way they suppress content that goes against the mainstream narrative, I need to make sure you're actually getting these updates. The truth has a price, and that price is often visibility. So subscribe now, and let's make sure you don't miss what's coming next. Because trust me, what's happening right now is just the beginning. Gold is trading at $4,821 as we speak. And I want to make something very clear from the start. This channel, Money Aftermath, exists for one reason only: to bring you verified information, real data, and both sides of every story. No hype, no panic, no manufactured drama to get clicks. Just the facts, the analysis, and the truth. Whether we're talking about market manipulation or strategic accumulation, whether prices are going up or crashing down, you're going to get the whole picture here. Always. So let's dive into what actually happened, because calling this a market correction doesn't even begin to cover it. This was strategic. This was calculated. This was, in every sense of the word, financial warfare. Now, I've been tracking silver's movement very carefully over the past several weeks, and I've been telling anyone who would listen that the $87 to $90 zone represented major resistance. This wasn't guesswork. This was technical analysis based on real price action, real chart patterns, real market behavior. We tested that resistance level multiple times, and each time we got rejected. The bodies of those candlesticks kept closing below that $90 mark, and that was telling us something very important. Pressure was building. Resistance was real. The market was struggling to break through, and then, overnight, everything just exploded, but not in the direction most people expected. Let me walk you through exactly what happened, because the sequence of events here is absolutely critical to understanding the bigger picture. On Tuesday, 3 million ounces of silver were physically removed from COMEX vaults. I need you to understand how significant that number is. 3 million ounces. In one day, nearly 2 million ounces were withdrawn from Asahi. Over 900,000 ounces came out of HSBC. Another 282,000 ounces left JP Morgan's vaults. And then, to top it all off, 2.5 million ounces were adjusted into LMIS registered category. The total COMEX silver inventory dropped to 400 million ounces. We haven't seen a single day drain like this in years. Physical metal is literally leaving the system at a pace that should have everyone paying attention. Real silver, the actual metal you can hold in your hand, is being pulled out of the traditional banking and exchange system. But here's where the contradiction becomes impossible to ignore. While 3 million ounces are being physically removed from COMEX, 600 additional silver futures contracts were issued delivery notices in just the first 4 days of February. All of them accepted for physical delivery. That's over 3,500 contracts in just 4 days. We're talking about 17.5 million ounces. Now, under normal market conditions, only about 1 to 3% of futures contracts actually settle for physical delivery. Most of them are just cash-settled paper trades. But right now, we're seeing 100% physical settlement. Every single contract is demanding actual metal. And there's a very simple reason for that. You cannot build AI data centers with paper silver. You cannot manufacture advanced weapon systems with futures contracts. You cannot wire solar panels or electric vehicles with promises written on exchange documents. The world needs real metal, physical silver, and the demand is absolutely exploding. So we have this incredible situation developing. Physical metal is being drained from vaults at record pace. Delivery demands are at 100%. Industrial need is surging. And yet, overnight, the price crashes 22% in 2 hours. Does that make sense to you? Because it shouldn't. What happened on the Shanghai Futures Exchange that night is genuinely one of the most extraordinary things I believe has ever occurred in commodity markets. 1.4 million contracts traded on just the April 2026 silver futures alone in a single morning session. That represents 674 million ounces of paper silver. And across all contracts that morning, 1.34 billion ounces were traded. Think about that for a second. That's almost double the entire annual global silver mine production traded in one morning, in one session. This wasn't retail investors panicking and selling. This wasn't mom and pop investors getting scared. This was a brutal, systematic, coordinated short selling attack specifically designed to crash the Chinese silver market. This was intentional. This was planned. This was executed with precision. But you know what didn't happen? The fundamentals didn't change. Despite this massive paper dump, prices in Shanghai remained at a significant premium compared to COMEX and LBMA. Silver remained in backwardation, which means near-term delivery is more expensive than future delivery. That's a sign of tightness, of shortage, of real physical demand overwhelming paper games. The paper manipulation isn't changing the underlying reality whatsoever. And then we start seeing signals that even experienced risk managers and market analysts are calling unfamiliar. Unprecedented. Strange. The spot price dropped $9. London spot moved into backwardation versus COMEX. The exchange for physical, which market insiders call EFP, is signaling extreme tightness in London even as leverage is being violently unwound in other markets. The regional divergence is screaming at us. London is currently the best bid. China and the United States are deleveraging aggressively. What does that tell us? It tells us we're watching a broad global deleveraging cycle where futures are being sold while physical metal is simultaneously being absorbed. Metal leaving the US and China appears to be largely speculative selling, people getting margin, called forced liquidations. But flows into London look like actual physical demand, real buyers stepping in. Now, I want to be crystal clear about something here because balance and honesty matter. This doesn't necessarily mean we're going to see an immediate price rebound. What this reflects is stress in a leveraged, paper-driven system. We're watching what appears to be a breakdown in the financialized market structure, with behavior starting to revert back towards actual spot market fundamentals based on physical supply and demand. The invisible hand of the free market, the one we learned about in economics class, is no longer operating freely. It's been replaced by very visible state action, regional policies, taxation, price floors, government intervention. These aren't theoretical anymore. These are real active forces in the market right now. The Shanghai Futures Exchange just announced new margin requirements for precious metals starting Monday. Daily price limits for silver futures have been adjusted to plus or minus 20%. Margin requirements for hedging positions are going up to 21%, general positions up to 22%. They're tightening the screws because the system is under serious stress and they know it. Now here's where this gets really interesting, and I want you to follow this logic with me very carefully because it's critical. Imagine you're short silver at $70. You're betting the price will go down, planning to buy it back cheaper later and pocket the difference. Then, suddenly, a government sets a price floor at $80. What happens to you? You're instantly underwater. Not because of normal market volatility, but because of policy. There's no pullback. There's no dip to cover your position. Trading below $80 is no longer allowed by law. Your loss is locked in immediately, $10 per ounce, $50,000 per COMEX contract. Margins get raised, liquidity disappears. You get a margin call or forced liquidation. And here's the part that should absolutely terrify anyone playing the paper short game. If physical silver is tight and someone demands delivery against your short position, your paper short suddenly turns into a physical obligation. You have to deliver actual metal. And if you don't have it, you pay whatever price it takes to get it, or you cash settle with massive penalties. This isn't a normal short squeeze where price just goes up. This is a state-backed repricing where the rules of the game change overnight. A price floor doesn't protect short sellers. It eliminates them completely. You can short paper all you want. You cannot short a government-mandated floor. The moment a floor is set, the old silver market is over. Now, could that floor be set below $80? Absolutely. But if it's set too low, here's what happens. Metal disappears from the market. Miners don't invest in new production. Refiners slow down operations. Physical supply dries up completely. Then the state either has to quietly raise the floor, buy metal directly from producers, or subsidize the gap. In other words, a low floor just delays reality. It doesn't change it. The real floor isn't a number on a chart. It's the price where silver refuses to sell, where holders won't part with their metal at any price below that level. Meanwhile, I'm watching mainstream financial media mock silver investors because silver traded above $120 and is now at $79. They're laughing at people who bought in, but those silver investors are still up 150% over the past year. Bitcoin is down 26% over the past year and trading even further below its high after erasing the entire gain it made since the election. But nobody's mocking Bitcoin holders with the same energy, are they? The double standard is obvious. Let me address the bearish factors head on because I promised you both sides, and that's exactly what you're going to get. This deleveraging is absolutely real. Speculative positions are being liquidated across the board. Margin calls are forcing weak hands completely out of the market. The environment is unfamiliar even for seasoned professional traders who've been doing this for decades. Markets are sending conflicting signals because these events are unfolding in stages in real time. Clarity will only come once this deleveraging runs its full course and the dust finally settles. If we close below $73, $74 on a daily candle, and I'm not predicting this, I'm just marking a technical level, we could absolutely see $70 and below. That's a realistic downside scenario in the short term. The technical analysis supports that possibility. But here's what's critical. None of that changes the structural deficit in silver. None of that changes the fact that 100% of COMEX contracts are settling physically right now. None of that changes the 3 million ounces that drained in a single day. None of that changes Shanghai maintaining a $10 premium despite the overnight crash. None of that changes the fact that the LBMA benchmark snapshot was taken and Chinese shorts should now be trapped in their positions. None of that changes JP Morgan likely closing billions in short positions at the bottom. And none of that changes the fact that demand for physical metal is accelerating, not slowing down. The state of Wyoming just started buying physical gold, and they specifically selected a private vault over JP Morgan. That's not speculation, that's official public record. Institutions are waking up to the reality that the traditional portfolio construction we've all been taught, 60% equities, 40% bonds, doesn't work in this economic era we're living in. US 10-year bonds are down 50% since 2020. Gold is up 3 times. And yet, current US gold holdings in typical portfolios average just 1.4%. 1.4. Imagine what happens to the price of gold and silver if even a small portion of that 40% bond allocation starts shifting into precious metals. Silver moves with gold in terms of monetary demand, but it has industrial demand layered on top. We're talking about AI, electric vehicles, solar panels, advanced weapon systems, 5G infrastructure. All of these require silver, physical silver, not paper promises. UBS just came out publicly and said they believe both gold and silver can move even higher in 2026. And here's something I've learned watching markets over the years. Pullbacks this violent in a secular bull market usually mark the start of the next major leg up, not the end of the trend. Institutional conviction hasn't wavered one bit. And the artificially low prices created by these paper raids are actually building the conditions for a major bull market in silver because they create even more real physical demand as available supply continues to dwindle. JP Morgan was fined nearly $1 billion for manipulating precious metals markets. They paid the fine and kept doing it. The markets are absolutely rigged. That's not conspiracy theory. That's documented fact. That's why you take self-custody of physical metal and get out of paper instruments. You're absolutely right. In just 90 minutes, silver was systematically demolished on paper exchanges. And anyone who's still leveraging silver on COMEX or trusting paper contracts and silver ETFs seriously needs to wake up right now. These instruments weren't designed to protect you. They were designed to drain retail capital and transfer wealth from everyday investors into the hands of the same major players every single time. Forced liquidations, but I always want to transfer real wealth to the same institutions over and over again. JP Morgan, State Street, BlackRock, all operating through the CME, which owns COMEX, same playbook, same outcome, same winners every time there's a crash like this. What we're witnessing right now is a war between paper silver and physical silver. Paper shorts pushed prices down 22% in 2 hours, using leverage and futures contracts. At the exact same time, the physical market is being drained every single day. Real metal is leaving vaults. Real delivery is being demanded. The disconnect between paper price and physical reality has never been more obvious. The most telling signal is coming from COMEX settlement behavior. This is the breaking point we've been watching for. This is where the system shows its cracks. Now let me frame what's actually happening here in terms that make sense. There's a famous quote from Jesse Livermore, one of the greatest traders in history, who wrote that the market will do whatever it takes to prove the maximum number of people wrong. That's exactly what just happened. This crash shook out everyone who was overleveraged, everyone who bought the breakout at $90 without a solid plan, everyone trading on emotion and hype instead of structure and strategy. The strong hands, the people who understand what's really happening, they're accumulating physical metal at these lower levels. The weak hands just got margin called out of existence. They're gone. And their positions just got absorbed by much bigger players at discount prices. So where do we go from here? I'm personally watching 3 critical things very closely, and I think you should be too. First, can we hold $73, $74 as support on a daily close? If we break below that level with real conviction, with volume and follow-through, then $70 and potentially lower is absolutely in play for the short term. The technical structure would support further downside. Second, Does the Shanghai premium expand or contract from here? If it widens, if that gap between Shanghai and COMEX prices gets bigger, that confirms the physical bid is stronger than the paper selling pressure. It means real buyers are stepping in regardless of what paper markets are doing. Third, do COMEX registered inventories continue bleeding? Because if delivery demand stays at 100% and inventory keeps dropping day after day, then the squeeze isn't just theoretical anymore. It becomes mathematical. It becomes inevitable. There's only so much physical metal available, and when it's gone, it's gone. Here's what I want to know from you, and I really want you to engage with this. Drop a comment right now and tell me what you're expecting. Do you think we're heading to $70 or below, or do you think we can bounce from here? I'm not asking you to predict the future perfectly. I want to know what you're seeing in your own analysis. What patterns are you noticing? What's your gut telling you based on the data? And make sure you hit that like button and share this video with someone who needs to understand what's really happening in this market, because the mainstream media sure isn't going to tell them. Let me give you 3 absolutely key takeaways that you need to remember from everything we've discussed. This was a leverage unwind, not a fundamental breakdown. The physical demand indicators remain exceptionally strong. Industrial need is growing. Delivery demands are at historic levels. Vault inventories are draining. These are facts, not opinions. Number 2, regional divergence is creating both opportunities and extreme volatility. You need to plan accordingly. You need to understand that different markets are showing different behaviors right now, and that spread between them is telling us something very important about where real demand actually exists. Number 3, the paper market structure is under stress in ways we genuinely haven't seen before. State intervention, price floors, margin hikes, exchange rule changes. These are not normal market dynamics. This is not how free markets are supposed to operate. We're watching the system adapt in real time to stresses it wasn't designed to handle. Now, I'm going to tell you the same thing I tell everyone who watches this channel. Do your own due diligence, always. I will never ask you for money. I will never pitch you on investing with me. I will never run paid signals or some exclusive trading group or manage funds. That's not what this channel is about. This is about information, education, and truth. Protect your capital. Stay far away from anyone using my name or this channel's name to run scams or pitch you investment schemes. If what I've shared here added value to your understanding of what's happening, then share it with one person who needs unfiltered truth over hype and fear-mongering. Just one person. That's how we build a community of informed investors who can't be manipulated by mainstream narratives. Here's the unresolved tension that's going to define the next phase of this market. We are watching a system transition in real time from paper-driven price discovery to physical-driven price discovery. How long that transition takes, how violent it gets along the way, and where the actual floor settles when the dust clears, that's still being written. The story isn't finished, but the direction is absolutely clear to anyone paying attention. The paper games can only last so long when physical demand exceeds physical supply. Math always wins eventually. Reality always reasserts itself. You can manipulate perception and you can manipulate paper prices, but you cannot manipulate the actual amount of metal that exists in the world. Now let's talk about what this means for you as an individual trying to navigate these markets and protect your wealth. The traditional advice you've probably heard your whole life about portfolio allocation is breaking down right in front of us. The idea that you should have 60% in stocks and 40% in bonds, that you should trust the system, that everything will always work out if you just buy and hold index funds, that entire framework is being challenged by what we're seeing happen. Bonds have been destroyed over the past few years. Real returns after inflation have been negative for anyone holding traditional fixed income. Meanwhile, gold has tripled. Silver, despite this recent crash, is still up over 150% from where it was a year ago. The traditional safe havens aren't safe anymore. The traditional growth assets are increasingly volatile and disconnected from underlying economic reality. So what do? How do you actually position yourself when the rules are changing, when state intervention is replacing market mechanisms, when paper and physical are diverging so dramatically? First, understand the difference between trading and investing. Trading is about short-term price movements, leverage, timing, technical patterns. Investing is about long-term positioning based on fundamental trends that you believe will play out over years, not days. Most people lose money because they confuse the two. They invest with a trading mindset or trade with an investing mindset, and both are disasters. If you're trading silver, you need to accept that volatility like what we just saw as part of the game. 22% moves in 2 hours can go both directions. Leverage amplifies gains and losses. Margin calls are real. Liquidations happen. You need tight risk management, clear stop losses, defined position sizing, and emotional discipline. Most retail traders don't have these things, which is exactly why events like this wipe them out completely. If you're investing in silver, if you believe in the long-term structural case based on supply deficits and increasing industrial demand and monetary uncertainty, then short-term price crashes like this are actually opportunities, not disasters. They're moments to accumulate physical metal at better prices, but only if you're not leveraged, only if you're not going to get margin called, only if you can actually hold through the volatility without panicking. Physical metal in your possession cannot be margin called. It cannot be liquidated by an exchange. It cannot be rehypothecated or lent out 15 times over in fractional reserve schemes. It's yours. That's the entire point of precious metals as a wealth preservation tool. They exist outside the banking system, outside the leverage system, outside the paper manipulation system. Now, I know some of you are thinking, but the price went down, so wasn't I better off waiting? And in hindsight, maybe. If you bought at 90 and it crashed to 73, sure, you wish you'd waited. But here's the problem with that logic. You didn't know it was going to crash. Nobody did. And if you're always waiting for the perfect entry, you often end up never entering at all, and then you watch the entire bull market happen without you. Dollar cost averaging, accumulating over time, regardless of short-term price movements, removes the timing pressure. It removes the need to predict every twist and turn. You're building a position based on a thesis, and as long as that thesis remains intact, short-term volatility is just noise. And here's the thing. The thesis has not changed. Industrial demand for silver is growing, not shrinking. Electric vehicles need more silver than traditional cars. Solar panels need silver. 5G infrastructure needs silver. AI data centers need silver. Medical equipment needs silver. Defense systems need silver. These are multi-decade trends that aren't going away just because futures contracts got hammered in Shanghai overnight. Mine supply is not keeping up with demand. We've been in a structural deficit for years. Above-ground stockpiles are being drawn down. Scrap recycling can only make up so much of the gap. At some point, price has to rise to either incentivize new production or destroy demand, and we're nowhere near the price level that would accomplish either of those things yet. Monetary uncertainty is increasing, not decreasing. Government debt levels are at peacetime records across the developed world. Central banks are trapped between inflation and recession. Currency debasement is the path of least resistance for policymakers everywhere. In that environment, hard assets with no counterparty risk become increasingly valuable as wealth preservation tools. These are the fundamentals. A 2-hour crash on a futures exchange doesn't change any of them. But let's also talk about the manipulation aspect, because I know that's on a lot of people's minds, and honestly, it should be. Is the silver market manipulated? Yes, absolutely, without question. JP Morgan paid nearly $1 billion in fines for spoofing and manipulating precious metals markets for years. That's admitted. That's settled. That's documented legal fact. But here's what people misunderstand about manipulation. Manipulation doesn't mean they can control price forever. It means they can control price in the short term to benefit their positioning. They can create volatility to shake out weak hands. They can use paper markets to suppress price while they accumulate physical. But they cannot repeal supply and demand forever. They cannot create silver out of thin air when industrial users need actual metal. Manipulation is most effective when it aligns with market conditions that allow it to work. When everyone's leveraged long and sentiment is extremely bullish, a coordinated short attack can trigger a cascade of forced selling that drives price down way more than the initial selling alone would accomplish. That's exactly what we just saw. But when physical tightness reaches a certain point, when inventories get low enough, when delivery demands are high enough, paper manipulation becomes ineffective because the people who actually need the metal for industrial use don't care what the paper price is. They need the metal, and they'll pay what they have to pay to get it. That's why we're seeing these divergences. That's why Shanghai maintained a premium. That's why London went into backwardation. The physical market is starting to override the paper market. That process is messy and volatile and creates opportunities for huge price swings in both directions, but the direction of the overall trend is clear. So what's my personal take on where we go from here? I think we're in for continued volatility in the short term. I think the deleveraging process might not be completely finished yet. I think we could absolutely test lower price levels as weak hands continue to get flushed out, and margin requirements force additional liquidations across the board. But I also think the physical market fundamentals are stronger than they've been in decades. I think state intervention is going to accelerate, not slow down. I think more governments are going to start accumulating gold and silver as strategic reserve assets. I think more institutions are going to shift their allocation away from bonds and into hard assets. And I think industrial demand is going to continue growing regardless of broader economic cycles, because the technology trends driving that demand are not optional anymore. They're essential to the infrastructure of modern society. Think about what's driving real physical demand right now. We're not talking about speculation. We're not talking about people hoping to flip silver for a quick profit. We're talking about industries that literally cannot function without this metal. The green energy transition alone requires massive amounts of silver. Every solar panel installation, every electric vehicle battery system, every wind turbine control system, These all require silver, and the amounts needed are not small. The artificial intelligence boom that everyone's talking about, that requires enormous data centers with massive power requirements and sophisticated cooling systems. All of that infrastructure requires silver for its electrical components. 5G networks being rolled out globally require silver. Military and defense applications require silver. Medical imaging equipment requires silver. Water purification systems require silver. This isn't a bubble driven by sentiment. This is genuine industrial consumption that's growing year over year, and it's happening at exactly the same time that mine production is struggling to keep pace. You cannot simply turn on new silver production overnight. It takes years to explore, develop, permit, and bring new mines into production. And at current prices, many potential projects aren't even economically viable. So we have this perfect storm brewing: declining mine output in some regions, increasing industrial consumption across multiple sectors, paper market manipulation creating artificial price suppression, physical inventories draining from exchanges, 100% delivery demands on futures contracts, government intervention changing the rules, and monetary uncertainty driving safe haven demand. Any one of these factors alone would be significant. All of them happening simultaneously creates a situation that I genuinely believe we've never seen before in commodity markets. Now, I want to address something that I know concerns a lot of people watching this. What if I'm wrong? What if silver just keeps going down? What if this whole thesis falls apart and physical demand doesn't matter and prices crater? It's a fair question, and it deserves an honest answer. Could I be wrong about the direction? Of course. Nobody can predict the future with certainty. Markets can remain irrational far longer than most people can remain solvent. Manipulation can suppress prices for extended periods. Unexpected economic shocks can change everything overnight. But here's the thing. My thesis isn't based on predicting what happens next week or next month. It's based on structural trends that play out over years and decades. And even if price goes lower in the short term, that doesn't invalidate the fundamental case. In fact, lower prices in the face of physical tightness would actually strengthen the case because it would accelerate the divergence between paper and physical markets even faster. If silver goes to $60 or $50 while industrial users are screaming for physical metal and inventories continue to drain, that just means the snapback is going to be even more violent when it comes, because at some point, price has to reflect physical reality. It always does eventually. The question is just timing, and timing is the hardest thing to get right in any market. That's why I keep emphasizing physical over paper. Physical metal in your possession doesn't have an expiration date. It doesn't get margin called. It doesn't care about short-term price fluctuations. It sits there as insurance, as a store of value, as a hedge against monetary chaos and system instability. If you're investing in physical silver, you should be thinking in time horizons of years, not weeks. You should be prepared for volatility. You should expect manipulation. You should